All right. Hey, everybody. Welcome to the morning market briefing. It's July 13th. It's a Wednesday. We got the CPI number. I haven't seen it. I'm going to get surprised when you guys are. Don't look it up. No spoilers. I did get a Teams message from Sam Frost, one of our analysts and portfolio managers, that said, quote, not good. So we're going to get into it. Tom's going to dig into the numbers so that we can have a little bit more informed discussion rather than just raw headlines. So we're going to open up today. Google planning layoffs. We talked in our macro presentation yesterday, which should be up on the blog and all that kind of stuff, probably in the next day or two. We talked a lot about kind of the slowing of hiring trends, especially among tech companies. Some of them are laying off people. Others are simply announcing that they're just not adding more people. Google, which has hired about 10,000 new employees in Q2, says they will be slowing the pace of hiring. Moving forward, they need to be more entrepreneurial. So they need to get more creative. They're going to be consolidating where investments overlap and streamlining processes. So this is going to be, I think, a very, very common theme. I think everybody in our office agrees that the slowing on hiring, the layoffs, expect to see more of them. We've been keeping a really close eye at initial jobless claims every week, specifically looking at that 4-week trailing number. We've started to see a little bit of an alarming trend there. I think that's going to continue to accelerate. When you're looking at companies that are as robust as Google and you see slowing on the hiring front, I think you need to realize that this is one of the best operated companies in the world, and they're facing this challenge. So the read through on smaller companies is relatively obvious, I think, in that regard. We've got earnings from a couple companies in. Again, we'll come to CPI in just a minute. We do have earnings in from a couple companies. Delta Airlines down 4%. Costs are weighing significantly on results. Earnings per share came in at $1.44. The expectation was $1.64. This despite being essentially in line with revenue. So their revenue came in roughly where they expected it to be. Passenger revenue was actually higher than they expected it to be. But costs are something that they're really having a hard time with. They offered guidance. They think capacity will be down in the third quarter. So something to keep an eye on. Bookings are still strong. They're still seeing accelerating airfares. A great quote is, with sustained strength in bookings, we expect September quarter revenue to be up 1 to 5% compared to where we were in 2019. Again, most of the airlines are looking back pre-COVID, and they expect total unit revenue to improve sequentially. So something to keep an eye on is really the elasticity of airline pricing. We talked about this as well in the macro yesterday, not to just shamelessly plug the content we've already given you, but it was pretty interesting to see record bookings and record airfares, but we're starting to see bookings decline. We'll see how that impacts the likes of Delta. Meanwhile, Pepsi reported earnings. EPS came in at $1.86. This is driven entirely by their ability to increase pricing. Their revenue was up 10%, almost entirely driven by pricing power. And that pricing power is coming from inflation. It's not necessarily a good thing. A lot of times when we talk about pricing power, you think, hey, they've got a lot of levers that they can pull as operators. This is something where they're just having to raise prices. So even just from the likes of Pepsi and from Delta and from Google, 3 companies we mentioned earlier, we're starting to see the 1-2 combination of inflation remaining persistent and a recession very much in the forefront. And we're starting to see that really impact companies. That's our warm up for today. The main event, though, is the CPI number. Tom, I'm still refusing to look. What were we expecting? Where did we come in? Talk to us.
Oof. So, I was kind of hoping. So yesterday afternoon, there was the first alarm bell went off probably about 3:00, where the White House came out and said, we are expecting an even more elevated number than perhaps initially anticipated on inflation. And that has turned out to be true. The expectation for June was 8.8% year over year. We came in at 9.1%, which is a significant increase from May, which was 8.6%. So we are re-accelerating into higher inflation. Bond market is selling off across the board, which is not a surprise at all. in terms of the things that are really accelerating, I mean, if you look, I'm looking at the breakdown here on the Bureau of Labor Statistics where they break it all out. And I've been kind of trying to quickly assess the damage while you were talking about Google. The big one obviously is gasoline. Month over month, it's up 11.2%. The entire energy space is up 7.5% just month over month and 41.6% year over year. So that's really driving this month. But if you look around, there's really no deceleration, to any real extent across the board. I mean, last month food was 1.2. This month it was 1. If you look at apparel, it increased in slightly. New vehicles and used vehicles were pretty flat. New vehicles up 0.7 last month, up 1. Used vehicles last month up 1.8. This month up 1.6. So you're not really seeing any fall off there. You're seeing pretty stable, consistent gains. Transportation services, airfare reaccelerated last month. It was up 1.3. This month it was up 2.1. So really, transportation and energy are the real takeaways in terms of things that are really reaccelerating, while everything else is pretty strongly holding. Not a real drop off anywhere that I can see where it's like, man, we really made some ground in this area. Almost everything is up. It's either flat or slightly down in most areas. And then you've got energy and transportation services really accelerating. I mean, medical care services too, 0.4 in May, 0.7 in June. So that, almost doubled month over month. And one of the numbers that's actually relatively low in terms of inflation this year. That's
it's crazy.
I mean, if you look at it, 4.8 year over year on medical services, but 0.7 of that came in the last month. I mean, it's a pretty significant uptick. It's not good. We are not seeing any exceptional changes. The big thing is if oil prices come down, the next number will be lower for sure, because that's really driving it, at least in terms of this print. And we have seen oil prices come down quite a bit over the last couple of weeks. And so this is backward looking. This is looking in June. So far for July, we're probably net down on oil. So there is some hope there that the next print will be lower, assuming we can get some sort of relief on gas prices. But everything else is holding pretty firm. So we're going to need cracks in multiple areas, whether it be food, shelter, transportation services, used cars. I mean, we got to find some relief somewhere where we can offset the energy. But this time the energy number was so high that there's nothing we can do in terms of CPI. So
and rates super interesting. Even in the last minutes, the 2-year treasury is now at 3.15% yield. The 10-year down to 2.95. So not only inverted, but a pretty deep inversion there.
This is the deepest inversion we've seen since 2007, and that's on top of where we ended up yesterday, which was also the deepest we've been since 2007. So we have a 30-year bond auction today. And my expectation is it might actually be very strong. And the reason for that is I think people don't want to bet on the next 2 or 3 years. They just want to say, hey, I want to lock in, make sure I'm getting a government guaranteed 3.25% yield on some 30-year treasuries and just ride that out. Contrast that with yesterday, where the 10-year treasury auction that we had was a disaster. Rick Santelli gave it a dog minus, which is the first time I've ever heard him say that. But he wanted to make sure that you knew that he was saying D and not B. We missed on almost every metric that they used for auctions. I mean, bid to cover was low, international demand was low. The dealers got stuck with the largest amount of it that they've had to in a couple of years. It was exceptionally bad, but that makes sense because everyone knew that there was a distinct possibility that we were going to have a bad CPI print today. So anyone who bought those 10-year bonds yesterday is now losing money.
Yeah.
And so that was in line with expectations. So I think that the flip side is going to happen today, where people are going to say that was a really bad CPI print. The next couple of years are going to be rough. I'm going to lock in here. So that's my expectation. Bond auctions are sort of tough to forecast because a lot of it involves foreign demand, but I think that's the real fallout, at least on the bond side from what I'm seeing this morning.
So Tom, 2 questions for you, and I'll set up this with a little bit of context. On Monday, we talked about, the major events for the week, the economic schedule. We had earnings coming in. At that point in time, we kind of felt like the CPI number was going to be less of a headline and less of a story than last month's, for instance. First question is the number bad enough that we actually change that view and we say, no, this is actually a really big deal? Second question, do you think this changes anything the Fed is planning in terms of a triple rate hike coming up?
Short answer is I would say it is not it's not as bad as last time. Just looking at the bond market, I mean, we had the worst day since Lehman collapsed on the last CPI print. Mortgage-backed securities went no bid. We'll see how the market looks when we actually get in there and try and buy some bonds today. But gut reaction, the initial reaction I'm seeing is not nearly as strong as it was last time, and I think that's because we also have recessionary fears. That's sort of the pendulum we've had.
That's the headline.
We're either swinging towards recession, which means people are buying bonds, or we're swinging towards fighting inflation, which means people are selling bonds. But right now we're sort of in a situation where, we're kind of in the middle of that balance beam because we have both on the table. That being said, the futures just updated for potential rate hikes, and we're actually looking now at it's saying 3.14 hikes on the 27th. So the door is now open for a full point.
Yeah, yesterday we were what, 295?
Yeah, and if you dovetail that with the fact that we had that very strong jobs report, and now we've got a very strong CPI, I think that there is a distinct possibility that we are now going to have a full point rate hike. I wouldn't say that the probabilistic outcome. I'd probably say it's 75% 3 and 25% 4. But I think it's on the table now. I think the Fed the door is wide open for them to get aggressive.
To go in one day on one economic data point, to go from we're not even at 100% chance of 3, at least on futures predictive market, to there's maybe a 15% chance that we get a full point.
Yeah, I mean the September one is now at 5.7. So that means that between now and then we're going to get 6, maybe 7, we could get 6 rate hikes pretty quickly. And before it was pretty much locked in, we're going to get 3 and then 2, but now it looks like we might get as many as 4 and then additional 3 in September. So, hold on to your hats. Let me go back to the bond market. See, we're already at a 320 on the 2-year.
Wow.
That's a significant move, but there's very little change on the 30-year, which makes me think that the auction will go strongly today.
We'll continue to keep an eye on that. Last story we have, kind of outside of the immediate economic data, President Joe Biden's going to the Middle East. He's going to stop initially in Israel. The goal of this trip, it's a 4-day trip, is to work on strengthening ties and promote stability in that region, specifically with Israel and Saudi Arabia. Obviously, energy is at the forefront of Americans' minds. They're thinking about gas prices. People want to see some kind of progress on that. What does that progress look like? I mean, what can he do? And I'm not saying this remotely as a criticism of Biden. I just don't know what levers he has to pull over there.
I really don't either. He's just got to, as it relates to gas prices, I don't know. We need to drill here. We need to drill now. We need to stop. We've already started pulling from the strategic reserve, but there's a report came out last week that, we pulled a million barrels a day from the reserve last month, but 6 of those went to China, which is pretty wild to be like, hey, we're gonna pull these out of this strategic reserve that is meant for national defense in order to bring gas prices down. But P.S., we didn't mention that of that we're going to be selling 20% of it to China, even though they're buying oil for 60 cents on the dollar on Russia, and they don't actually need it, but it's extremely destabilizing for us. So it's pretty. I don't know. What we need to do is stop taking oil out of the strategic reserve, drawing it down, and then sending it overseas.
Yeah.
I think that's not in our best interest, but that's something that is happening. And so, I think we need to focus on the U.S. But that doesn't seem to be a priority. And so I don't know what the catalyst is unless we change policy at the executive level.
Yeah, I agree with you. We got to figure out something. And I think there's a big distance being created. I was speaking with a client yesterday, and again, this is going to sound more political than I mean it, but I do think there is a palpable disconnect between the executive tone, not only specifically on gas prices, but also as it relates to, the Russia-Ukraine conflict. Hey, we've got to bear the cost of this. There's such a difference between how even European nations view that. They're significantly less inclined than our president is to say, hey, we need to be involved in this. And I think there's a lot of people out there that feel like policies aren't supportive of the American people. And to be clear, that's not only a Joe Biden thing. It's not only a Democrat thing. It's just a disconnect that exists. And I think it's going to be interesting to see how they attempt to reconcile that.
I mean, we've already spent 5 times as much money sending money to Ukraine as it would have cost to build a border wall, and no one's batting an eye, and so I think that's an interesting to think about in terms of context of just the sheer vast amount of money and resources that are being taxed off of the American people for another country, which is it good? Is it the right thing to do? Perhaps, but at a certain point, given the economic landscape, it's a very serious drag on our economic activity.
Yeah. We're going to wrap it up there. We'll be back tomorrow. Could be a pretty interesting day, I would say, in the markets. I think, especially in fixed income, market futures have, equity side have just absolutely fallen off a cliff. In the few minutes we've been on this call, when we started the call, S&P futures were up, I want to say, around 40 basis points. They're down 1.5% right now. So we've had about a 2% swing just while we've been talking. So we're going to stop talking, and maybe they'll come back. We'll talk to you guys tomorrow.